Welcome to summer in the inland Northwest. Snowbirds have returned, days are long, and boats are in the water. Whether you spend your days in the lake, at the golf course, or on the trails, it's a great time to be outside in the inland Northwest. Of course, many of the challenges we face don't go away with the cooler temperatures. Supply chain issues persist, as do housing shortages. Gas prices are rising along with interest rates, while stock prices fall and war persists. All the while, COVID is out of the spotlight, but not completely removed from our daily lives. But here in the inland Northwest, we aren't afraid of a little adversity. We are nothing if not resilient, resourceful, and perseverant. At the Journal of Business, we endeavor to keep you, our readers, informed about what's happening in your community. Our staff is dedicated to providing you with clear-eyed, objective information on news and trends, with the goal of helping you be more successful on your chosen path. It's time to go beyond the sound bites. It's time for more depth than 140 characters can provide. It's time for elevating the conversation.
Well, good afternoon and welcome again to Elevating the Conversation. My name is Paul Reed and I'm honored to serve as publisher of the Journal of Business. I'm also honored that each month so many of you choose to join us for some great discussions we've been having. You know, we started this program about a year and a half ago for that reason, because you asked us for a venue at which we could have important conversations about issues affecting our business community. And we've done just that. We've had some great guests, including Stephanie Curran, Frank Velezquez, Shelley O'Quinn, Jim Frank, Steve Scranton, Larry Crowder, Chef Chad White, and many, many others. Next month, we're happy to have back with us Keonta Duncan, president of NAACP, for another discussion about diversity, equity, inclusion, something we plan to do each year. But today, we're very pleased to have with us Melissa Murphy of Prime Real Estate Group for discussion about the inland Northwest housing market. There's no lack of interest in that subject right now. As all of you are well aware, there is a housing shortage. We've had skyrocketing home values. So where do we stand now and what does the future hold? This should be a very compelling conversation. But before we get to that, I want to thank Canopy Credit Union for sponsoring this month's Elevating the Conversation. We don't get to do these things without some great partners, and Canopy Credit Union has been a great partner for the Journal of Business for some time. Today, I'm pleased to have Megan Shover of Canopy Credit Union with us to say a few words. Welcome, Megan.
Hi, everyone. I'm Megan Shover, Vice President of Culture and Marketing at Canopy Credit Union. I want to thank the Journal of Business for bringing us together through the Elevating the Conversation series. Many of us are aware of the ever-growing and competitive housing market in Washington State. We know there are countless challenges facing potential homeowners right now, from price inflation and inventory shortages to understanding which path is best to walk when applying for a mortgage loan. However, at Canopy Credit Union, we are doing our part to relentlessly counteract these challenges. We offer free one-on-one financial coaching to all of our members and non-members. Our coaches meet with you to review your whole financial picture. They help you determine a realistic budget, increase your credit score, and set short and long-term goals, all while bringing you that much closer to homeownership. Canopy offers fixed conventional 30-year mortgages for as little as 3% down, making it more possible than ever to not only get a shot in this competitive market, but thrive. Many of our members come into the home buying process overwhelmed and unsure. We make sure they leave feeling empowered, confident, and ready to embark on their next chapter. Canopy makes the dream of homeownership a reality, one story at a time. I would like to introduce you to Ryan, a member at Canopy, who recently went through the home buying journey with us.
In the beginning, when I first was going to buy a house, it was really scary to me, and I was kind of like had all that fear, like, are they going to tell me no, and I was super worried. And then when I came in here, I just had this really comfortable feel, and I told him what I was trying to do. I was trying to, finally step up and buy a house, and it was this kind of overwhelming attitude, like, yeah, well, we're going to get it done, like we're going to make this happen. And I was like, okay, I can do this. This is good. So I feel like I went in there with a Red Bull and Snickers and walked out with my first house. That's what I always tell people. So the first house we bought, we went in and started doing sweat equity and upgrading the kitchen and, fixing the bathrooms and doing everything we could. And then over the course of a few years, like the market going up and paying down the loan, we were able to secure a decent amount of equity. in the property, and we decided we wanted to maybe start expanding our portfolio and using the equity to maybe buy another property. So when it seemed right, we had done the renovations, we came in and got a home equity line of credit and started looking for something else that we could buy. I wouldn't have been able to buy my first investment property, and I wouldn't be able to fund the remodeling on the one I have going on right now. You know, it's been something I had thought about for a long time. It's been something that was a goal of mine and I've been working towards. And, you know, all that fear of am I going to get denied, or is this going to work out for me, or do I make enough money? And then, you know, walking in the front door, I just realized, like, you know, this was a reality in that, and I'm a homeowner now. So it's pretty good.
Welcome to Elevating the Conversation. My name is Lynn Parrish. I'm the editor of the Journal of Business. I'm joined today by Melissa Murphy. Melissa is the owner of Prime Real Estate Group and real estate agent, broker, TikTok influencer. Influencer, is that right?
Influencer, I think that's the word now, right?
How are you doing?
I'm doing well, Lynn. Thank you so
Good.
much for having me.
Yeah, glad you're here.
Well, the caliber of speakers that I know you've had presenting before is quite a impressive list. So I'm honored you reached out to me, and I'm honored to be able to speak about the real estate market here in our area and what we're seeing right now.
Yeah.
So,
you know, Melissa, I was initially wanted to do this in April, and then we kind of rejiggered the schedule, and we're doing it in June, of course. And I'm glad we did, because it's a much different conversation. I get the impression it's a much different conversation now than it would have been in April. So what kind of changes are we seeing in the residential real estate market right now?
That's an excellent point. I think, yes, in April, we weren't really seeing a shift. And actually, I was thinking back to a time where I did a national podcast in July of 2020. And one of the commenters said I was too optimistic.
Okay.
I may not get accused of that today. So it'll be interesting to see how the market sentiment has changed, albeit rather quickly. So yes, the market has definitely shifted. We've got some interesting data out. And of course, I always say, in the field, we feel like we're a little bit of a bellwether of that consumer sentiment and what we see coming down the pipeline. And it has definitely changed in the last couple of weeks.
Well, let's dive in. Where are you seeing the most profound changes? Is it inventory or time on market? What are you seeing? We're
seeing a little bit of both. So what's interesting is inventory is up about 116% here in Spokane County. Now that sounds like a huge number. Wow.
It does, yeah.
But when we see what historic lows we came from, I mean, we have, as has been in the headlines for so long, we've really had a dearth of inventory that's been, certainly the entry level price point has been on the national scale problematic. But here locally, those prices just keep climbing and climbing, specifically as we've seen such strong demand.
Sure.
And of course, on the supply side, I think we've seen raise in inventory costs of about 19% on the home builder side. So it's hard to get those units out specifically for that lower price point.
Right.
So it is causing a lot of problems because we're having, we've had such a demand issue in the last couple of years, coupled with the supply chain issues. So it's just really hard to meet those needs.
Sure.
Now we're at a period where rising interest rates are really, as one economics expert put it, is just a math problem.
Sure.
And the challenge we're seeing right now is, of course, I always use the rule of 1 in 10%. So every 1% change in interest rates affects a buyer's ability to buy or their affordability by 10%.
Sure.
So when interest rates in 2020 dropped so quickly, it was easy math. You saw values go up 10, 20% almost overnight, almost as a reaction to those interest rates.
Sure.
Conversely, now that we're seeing interest rates up almost 3% since where they were a year ago, we're starting to see that roll through the market, since that affects a buyer's ability to buy in the average price point anywhere from $600 to $800 a month. So it really is kind of creating almost the perfect storm in the housing market right now that some of the pundits are finally acknowledging is a shift change.
Sure. So let's put it in perspective, because when we talk about rising inventory, I mean, it's the joke would be like, we're going from 3 to 7.
Absolutely.
And so,
Absolutely.
so it's not like a glut of houses on the market, but are we seeing houses
stay on the market longer at this point, and what is considered long at this point? Yeah.
That's an excellent point, because
Yeah.
I remember having been in the business now almost 17 years. I
Sure.
remember at the bottom of the market in 2012 and 13, the average days on market we'd prepare a seller for was 90 plus days on market,
Of
which was
course.
normal, which, oh my gosh, if you tell a seller today you're going to be on the market for 3 to 6 months,
You're out.
I would explode.
Yeah.
So it's a very, very different conversation. So when we say that days on market is tripling and you could see 2 weeks on market,
Mhm.
it's managing expectations for what used to be the norm for the last 24 months was hours on market, multiple offers as the norm. They're still happening on occasion, specifically in that entry level price point. But what will be interesting to watch that a lot of the experts are focused on is really that upper end that could put compression on the lower end
Yeah.
market, just simply because it can be seen as more of a discretionary or luxury item. And as you know, as everyone's 401ks feel like 301ks right now,
Sure. Yeah.
there's going to be that pinch that we might see reverberate throughout the market.
Right.
So-
Right. But at this point, we're still very solidly in a seller's market, of course.
Depending on which metric you look at. So
Okay.
if you look at the Fred website, they do a market hotness indicator. And
Okay.
what's interesting is we've been actually hovering around 50% market hotness for both Spokane County and Kootenai County up prior to 2020.
Mhm.
2020, Kootenai County exploded and
Mhm.
hit 99% on the hotness indicator.
Sure.
Most recently, May of 2022, it's below 15%. So
For Kootenai
certainly
County specifically.
for Kootenai County
Okay.
specifically. Now, Spokane didn't quite reach that peak of desirability. We were 82%, which is
Still
darn
pretty
close.
hot.
Still very
Yeah,
hot.
yeah.
Again, since our historical average was about 40 to 50%, and we're now trending around 24%. So
Sure.
again, that is a little bit of a swing. It has to do with the combination of in-migration, listing visibility, demand, buyer traffic, things like that. They're all making up that composition. So
Sure.
it's just interesting how quickly that changed, because again, real estate in general as an asset class tends to be a lagging indicator in the economy.
Right.
So because it is so slow moving, for instance, if you go back to the GFC, which would be the 2008 financial crisis, from peak to trough, that was a 6-year trend.
Right.
So it tends to be very slow moving and lagging. So it'll be interesting to see how when some of the numbers come out about what inventory is doing, and prices are down, and pendings are down. Prices are still up considerably year over year, but will that hold? It's interesting to see the headlines change literally week by week.
Right. Right.
So
And so I guess what what I wonder about
Yeah.
is, we talk about seller's market, buyer's market,
right,
but what I wonder about is healthy market. So
right.
what we've seen over the last 2 years or so,
Mhm.
you hear stories about offers without home inspections,
Mhm.
no concessions, certainly no seller's costs.
Right.
Buyer's costs being covered, and that sort of thing. And so it's very good if you're selling a home,
Mhm.
but it's not what I would consider a healthy market. There's still people getting into situations that are
Yes.
not ideal for them, right?
Right.
And so what do you see, what needs to happen for us to have a more healthy market, and when do you see that happening?
Ooh, that's a great question, because number one, yes, the market was incredibly imbalanced. Buyers were buying homes sight unseen, waiving inspections, waiving appraisals, putting money towards in the event of a low appraisal, letting sellers rent back for months at a time, you name it, non-refundable earnest money that was forfeited upon mutual acceptance. It was insane.
Mhm.
So to back off of that is a good thing. What's
Sure.
interesting that is a puzzle that nobody's yet been able to solve, even the housing experts, is you go back to the GFC, there was 69% of home ownership, and that level dropped. And it's interesting because as we saw interest rates drop, we would expect it would get more people into the market.
Sure.
But of course, what's interesting is we're still off by 5% of that homeownership rate. So we all want that homeownership piece. And The narrative has been that inventory is an issue, but we're also feeling like it's been a combination of inventory and affordability, and that affordability has gotten even worse.
Sure.
As I mentioned with that supply issue, we're just not seeing that entry level inventory that would fulfill that demand, and that's really challenging right now.
Sure.
So, there's a lot of components to that. I mean, again, when we look at kind of the government's response to COVID and the fact that basically they did quantitative easing, dropped interest rates, the question, of course, is that fed the demand side, but we didn't see the supply side.
Sure.
So as kind of a micro picture, that's something that we're still really struggling with, is how do we deliver more units to that affordable price point to really make a more stable market? Because again, it definitely has been rather imbalanced. So as we're starting to move towards maybe moderate, healthy, or normal, I think that could be very welcome by many.
Yeah, that's good
So-
stuff. The one thing I wonder about when we talk about some of these, or I guess I think you could call some of them unnatural
Yeah.
factors in the market,
Yes.
is the role that investors play in that. And so, because and you'll see stories not specific to Spokane, but
Right.
in national publications about companies, corporations going in and buying several homes in a given neighborhood or something like that. And it as a percentage of overall sales, it's not
Right.
great, but it is a factor. And so what's going to happen with that market as we move forward?
That's a very interesting variable, which gets into that home ownership piece that hasn't quite fully recovered to the levels that we were hoping for. That is a big variable in our marketplace, because again, when you're looking at all these bidding wars, you didn't know if you were competing against, specifically, we didn't see it in the Spokane market, but again, on a national scale, Blackstone Group or other groups that were buying up huge swaths of houses. There was one that I remember where they picked up a whole community in Texas, new construction, sold it right to an investment group. What's going to be interesting, of course, is those groups are asset class agnostics, meaning they're committed to real estate. So again, if their yields change to US Treasuries with rising interest rates, they're going to quickly put that inventory on the market if they perceive a signal of potential risk or potential market downturn. And again, please their investors to get the rate of return that they want.
Sure.
And that, of course, could put more inventory on the market, and more inventory, of course, could lead to some price corrections. The other facet that we haven't really addressed that has been rather quiet was the forbearance program, which has been wildly successful.
Sure.
So the number of
That's a good
homes
point.
that went into forbearance was, I think, and I'll have to double check my math, but I think it was 2.8 million. So that number is now down to 700,000 severely delinquent households. So again, the number came down dramatically, but that still is a number that, due to government regulations, hasn't been able to be foreclosed upon, that could add inventory to the marketplace.
Sure.
So again, that's kind of a to be determined on when that will increase inventory. And then again, as we talked about the lower inventory, home building actually is finally at a peak, still not as high as it was in 06 and 07, but it's 1.5 million units that are currently under construction. Now that's split half between single family homes and apartment complexes. The question, of course, is here in our local market, buying new construction has been quite a whirlwind. So for instance, last year, working with a client, a new lot would come up, the builder would release it, we'd bid with about 10 to 15 other buyers, pay $100,000 over the list price before upgrades, and then wait 10 months for the house to be delivered.
Sure.
Now we're starting to see more inventory come on without such a process, and it'll be interesting to see what happens to any of those existing inventory units, if they all still come online on time, on budget, with the same buyers in place, or if that starts to add to the inventory picture.
Sure. So are we seeing any, in the new construction market, are we seeing any speculative building at all right now?
We are, but a lot of times it pales into comparison to what it was in the 2005, 2006 market.
Sure.
So it's a lot more calculated. And for those that are not speculative, where they do have an end buyer in place, we're seeing bigger and bigger deposits as a hedge against changing market winds. So there's one local builder who's commanding 20% non-refundable earnest money. So it's going to take a lot for a buyer to walk away from that.
Yeah. And that's a chunk of change.
That's a chunk of change.
Yeah.
So
Yeah.
no, that component alone could add some inventory. But you're correct. The speculative piece is certainly not to the percentage that we saw it prior to
Sure.
the GFC, where again it was an inventory issue. There was
Yeah.
just too much of it.
Yeah.
So.
Now, I'm into this, so I haven't
Yeah.
neglected to mention that
Yeah.
we are going to have a period of time after Melissa and I are done with our conversation where we'll take your questions. So please type those into the question function in the chat at any time, and when we're finished here, we'll make sure we get to those.
Perfect.
So I get the feeling as somewhat of a layman, it would be easy to say we've seen this movie before, when we talk about
Right.
2007, 2008, 2009. And I had kind of forgotten that the market didn't really hit the trough until 2012 or so,
Right.
because it was so dark at that time.
Right.
But it whipsawed, it went from being white hot to non-existent in a very short period of time. I don't feel like this is like that, but I can't tell you why. So would you say this is similar to what we saw in the ramp up to the Great Recession, or is it different in some way?
There's a saying, history never repeats itself, but it often rhymes.
Uh-huh.
And so this does feel different. And to your point, we can't quite put a finger on exactly what is causing the winds to change, other than there's a lot of bad news out there.
Yeah, sure,
So
sure.
for the combination of inflation to Ukraine to the yen currency crisis, there's a lot of bad headwinds out there. And I think it's causing people to pause, because
Sure.
remember that our economy is 70% consumer confidence.
Mhm.
And when those winds start to change, that can affect people's confidence in making big financial decisions.
Sure.
I think there was a recent University of Michigan small business study that came out that said small business owners were the most pessimistic they've been since the.
I saw that.
Did
Yeah.
you see
Yeah, I
that?
did. Yeah.
Since
yeah.
was it 1959 or mid 60s
So,
somewhere? It was a long time,
before our
right?
time, yeah,
Way
yeah.
before our time. So again, if businesses are feeling a little bit more cautious, they're not going to do CapEx expenditures, new hirings, make big moves, the household who is going to make a big purchasing decision may as well find themselves a little bit more cautious.
Sure.
But what's interesting is, as we're looking at real estate prices in general versus a historical outlook, which the closest example we would have would be the 1970s,
Sure.
a period of inflation,
Right.
we have to look at what prices are going to do. And there's a big difference, of course, between nominal prices and real prices. Because remember, nominal prices could effectively go up if we're still in an inflationary headwinds, but you're not really getting anything for it.
Sure.
So that's really what's interesting, is if people have this quotes fear of prices coming down, remember that if we still have this inflationary headwind that, again, depending on your input and the Fed's policy decision of the 0.75% interest rate increase yesterday, some people are saying we're not raising rates fast enough to offset the red hot inflation that we have.
Sure.
So we might see prices stall out or continue to rise, but your purchasing power goes down.
Right.
So it just doesn't feel the same, right?
Yeah. And people are always going to move for jobs or lifestyle or that sort of thing.
Right.
But if you're sitting on a mortgage at 3.5% or something like that, and
Yep.
now the rates are at 5.5, 6.5,
Yep.
wherever they go,
Yep.
I think that's a tougher conversation, tougher decision to make.
It's a tougher decision, and it might lead to some trapped equity. And so
Mhm.
that trapped equity, because again, you can't refinance and pull it out, because again, if you're at 2.5%, you're not going to refinance it yesterday's rate of 6.28%.
Sure.
The math just doesn't work. So it'll be interesting to see if where we see that market segment maybe shift. And there's a couple experts who are looking for where that could be. It'll be interesting to see what gives first. Some people expect it to be in the higher price points, the luxury
Sure.
market, because again, that's discretionary. And if you're at 2.5% on $1 million home, that's easy math. 2.5%, or excuse me, 6.25% on $1 million home is a very different equation.
Yeah. Very
So-
different conversation.
Very different.
So do you see people making decisions or realtors making recommendations based on what the decisions the Federal Reserve are making at this point?
Interest rates do drive a lot of decisions.
Mhm.
Now, when you're having a conversation about whether to buy or sell, a lot of times you have to look at what your circumstances are.
Sure, of course.
Is it you're making a move because you need to, you don't like your current house? I almost feel like the last 2 years was like the most incredible game of musical chairs. Everybody moved, right?
Mhm.
They took advantage of the opportunity to upsize, downsize, right size, you name it. And so now that the music is slowing down a little bit, it is going to take a lot to compel somebody to take that first step. Now, again, the entry price point is really solid because people are still making a move. As we're seeing threats of interest rates continuing to rise, they understand the dynamics of making a move now. But again, it'll be interesting to see those wins if interest rates do go up, because again, some people are saying the Fed wasn't aggressive enough. And if their median expectation for the Fed funds rate is to hit around 3%, and we just hit 1.5%, higher interest rates could be on the horizon in the future, unless the Fed gets wind because inflation starts to tamper down, and then
Mhm.
they can back off and roll it back down.
Sure.
So we'll see. I mean, again, it's interesting that again at just 0.75 basis points, we've already seen kind of that softening already.
Sure.
Home builders have kind of missed their metric. You know, the housing market news is starting to turn a little bit.
Mhm.
So again, they might have enough breath to kind of back off that policy,
Sure.
which I think
Sure.
everyone would be happy about.
Right. But are you or your colleagues making
Yeah.
recommendations based on what's happening in those interest rate markets, or is it really a case by case basis?
It's really a case by case basis. If you already have intentions to sell or intentions to move, I'd make that decision sooner rather than later. And again, if you're intending to buy, what probably should be your basis for your decision is if the property has utility for you. You know,
Mhm.
if it's something that you're not using or a rental property that's not cash flowing, that's the time to make a move and potentially reevaluate your options.
Sure.
So an interesting tidbit on that, we were running some numbers for a client. So we have the brokerage side. So I help people buy and sell in Spokane, Coeur d'Alene, and Sandpoint. And then I have agents. I've got a team that works for me. So I help mentor, train, and help them. We
Sure.
also have the property management side because I became an investor when I got into the market in 2005 as well. And so it's interesting to watch. We also manage short-term rentals. What's interesting is we're starting to see a little bit of the vacancy rates on those go up as we're seeing more market saturation.
Oh, sure.
So here's
sure.
a fascinating metric. In Kootenai County, there's 888 Airbnbs or VRBOs.
Wow.
Spokane County, there's 865. And clearly the metro areas are a little bit different,
Yeah,
right?
right.
So if you acquired a couple Airbnbs with the anticipation of basically having a huge profit center, but you're starting to see the increased saturation in that marketplace,
Mhm.
and maybe a little cause from consumers or tourists if the cost of travel, cost of gas, cost of housing is going up, we might see people pull back on that. And that might be one of the first shoes to drop as people start to say, this just doesn't make sense, and head for the exit there.
Sure.
So
sure.
that might be a spot where inventory does come online.
We haven't seen, from what I've seen, we
Yeah.
haven't seen softening on the vacancy rates for apartments yet.
Precisely.
But that could also be a factor in that market. Now that might still be a ways off though, because those vacancy rates from what
Right.
I've seen are still pretty tight.
The vacancy rates are incredibly tight, and the cap rates again for multifamily has been staggeringly low. We're seeing about a 4.5% cap for
Sure.
new acquisitions, again driven wildly by interest rates.
And just a basic,
Yeah.
for those who don't know, for capitalization rates,
Yep.
lower means
The lower, so the lower means an investor's willing to take a higher level of risk for a lower rate of return.
yeah.
Back in the good old days, we were at 10%, and that
Yeah.
was our rule of thumb: is
Ah.
I'll buy that rental property if I get a 10% rate of return. We used to have a lot of outside investors who sought out Spokane specifically because our rate of returns typically have been 5 to 7%, sometimes 8%.
which is
We're in
healthy.
the, which is normal.
Yeah.
We're in the more pricey, expensive coastal markets. You might see a 3% in San Francisco.
Sure.
So when we see that rate get compressed, it means you're willing to accept a lower rate of return, and we might start to see that tick back up again as a variable of interest rates and rents. What's fascinating though is Coeur d'Alene reported a 35% increase in rent.
Mhm.
That is incredible. Spokane was also leading the country on a 100 city index
Sure.
recently. And it's surprising because, as we know, affordability is a major concern, specifically when you get to the rental market.
Yeah, it's
So-
also been a selling point for our community
Oh, absolutely.
for decades. Yeah, yeah.
Absolutely. It's, and I think we chatted about this over the phone is, as we were preparing for this call, is one of the interesting factors that drove a lot of people here during the great migration, if you will, of the last 2 years, where everyone could work remotely and had the opportunity to make a move, was affordability.
Mhm.
And we had the affordability that brought everybody here with their low interest rates in tow. We've got a math problem now. That
Yeah.
affordability isn't there. I mean, I've got to double check my numbers, but I think we are, I just looked at the numbers of what we were for Spokane County, and I want to make sure I state it correctly. So the average price in Kootenai County as of right now is $752,000, up from $583 a year ago. That's a 29% increase in
Mhm.
1 year. And here in Spokane County, we just hit $518 as the average price. A year ago, it was $452. So that affordability piece, now that it's lacking, will we still see the same in migration to the area? It's going to have to be job-based or quality of life-based,
Mhm.
which again, we know is still very strong. I was just talking to a gentleman this morning who moved from the Seattle area, and he says he's never leaving.
Yeah,
so
sure.
we do have that very high quality of life. It's just making sure that affordability matches.
Yeah, although we have seen these on maybe smaller degrees,
Yeah.
these influxes of people from other places before.
Right.
We've also seen some of them leave when they experience their first real winter.
Yeah, that 4-letter word called snow. Yep.
Yeah,
Right.
Well, I want to get to the questions here pretty quick, but I did want to ask you another
Yes.
question, and it's a little bit more academic, but
Okay.
I wonder when we talk about the residential real estate market, if what factor demographics will play
Yes.
in the near future. So before the pandemic, I read
Yeah.
a story that said that we could expect a surplus of properties on the market
Yeah.
in the 2030, 2035, as baby boomers were divesting of their assets. And so I'm wondering if that's still a factor that we'll see it long term, but in the next 5 to 10 to 15 years.
I would say there's a very high probability of that. Demographics is always a big driver. And one of the other variables that everybody said has been driving the inventory shortage is because we have baby boomers who are very accustomed to holding real estate, because real estate values have gone up pretty much their whole life. So they're very attuned, accustomed, and comfortable holding multiple holdings, a house, a condo, a vacation property, etc.
Mhm.
And then the millennials who are at their peak basically purchasing point, household formation age, again, is the largest demographic group. So you've got these two big demographic groups at the same time.
It's a barbell.
It is, exactly, exactly, holding inventory. The interesting variable, of course, is the replacement rate of the next generation is slumping.
Mhm.
So we don't have that next generation to come in and backfill that. So again, if you do have the baby boomers start to sell off into the marketplace, that could put excess inventory into the marketplace.
Sure.
So that is a very interesting variable to watch in the future, because at this point they've been very comfortable because people are living longer, staying in their households longer.
Mhm.
So it'll be interesting to see, but that is definitely a variable to watch for
Yeah,
sure.
Good.
So
I've been monopolizing your time.
no,
Let's see
these
if we can
are
get to,
fantastic questions. We could
some
talk all
questions.
day
Yeah, I
about
could, yeah.
the market, but
So we have one question so far from Mike McBride. Thanks for the question, Mike. He asks, how much demand into the Spokane market continues to come from outside the area, and has that changed since the height of the pandemic?
yes, I would say that it has definitely changed. And it goes back to what we talked about on affordability. Again, it's just math. When you're going from a very expensive market to a more affordable market and interest rates are good, you can then hedge against that cost of living. Now that we're starting to see that increase, it still has to be driven by your ability to work remotely, which again, thanks to technology, we saw anywhere from 15 to 23 million people be able to work remotely. So again, that's something that certainly brought more people here, and we hope that they stay, and we hope that employment metric still allows them to work remotely. We have seen that slow down a little bit. So, and again, I think it has to do with that affordability number. So,
Sure.
but
Sure.
it is slowing down.
Let me just ask a follow-up to that. So as interest rates rise, and it piggybacks off of Mike's question, more people are coming into the market with cash offers. So how does that influence demand? While interest rates are rising, you still have a lot of people who probably don't need the interest rate decision.
Right. So the interest rate decision, of course, is a big factor for those, and it marries well with affordability. But if you just sold your property that you had in Seattle that you bought in the 1970s for $250,000 for $2 million, you don't care what interest rates are. And so you're still going to always have that segment of the market. And we did see a lot more cash purchases in the last couple of years than we have seen before. What'll be interesting is as we're starting to see a slump in the stock market, specifically in some of the tech sectors, we have to watch as a leading indicator if we're going to start to see some of the people who have been relocating this way, who tend to, what the feeder markets have been for such a tech heavy area like Seattle,
Sure.
Silicon Valley, et cetera, because those are our feeder markets. So we're typically and traditionally seeing people sell there and come this way. So it'll be interesting to see that that asset class and see if people start to, if we still see that migration. But yeah, there's still a lot of cash buyers who do migrate this way from the big cities for the quality of life and affordability.
Great. And question from Chrissy Roy. I know we are seeing a softening in the real estate market. Could this softening be contributed to the time of year, beginning of summer, people going on vacations, kiddos going to summer school, etc.?
That's a very good point. And actually, I recall when I looked at the inventory numbers for last September, when talking about market timing, I recall sharing with some sellers that actually last September was one of the worst times to sell your home because of the increase in inventory on a basically per buyer basis. So yes, we are entering a period of time where we're seeing a peak of inventory, but I think it is a little bit more than seasonal just because of the
Sure.
rate of change and the number of buyers that we're seeing on a national index that tracks buyer traffic through listings that is dipping. Just recently, I typically can tell you the moment a listing hits the market, almost to the second. That has changed. And again, when we go back and look at the run up to 05, 06, 07, there was some similarities, some corollaries to how much visibility was, how many multiple offers we had, but the number of showings per listing is down dramatically, even in the last 6 to 8 weeks. So another metric to watch, of course, is price decreases. So we noticed that was also a metric. I looked at the stats yesterday. There were 49 new units on the market or houses and 98 price reductions. So that was a rare number to see. So.
Sure.
And a question from Greg Francis, have zoning restrictions in the Spokane market hurt or helped? It seems like they might keep prices of single family homes higher, but limit options for more housing types like duplexes and et cetera.
Greg, that is my favorite question. Thank you so much. When I talked earlier about supply and demand, we essentially fed the demand side, but we did not address the supply side. And I wish I could say there was a municipality or a county that was appropriately addressing this issue, because we have to remember that 95% of single family residential zoning, 95% of single family zoning is very limited. You can't easily add an ADU or a duplex or really make modifications that would easily increase supply. Mm-hmm. Only 5% of that zoning is set for commercial or multifamily properties, which keeps the the value of multifamily properties higher. But of course, even just a couple tweaks to zoning that would allow more diversification of the single family asset class to allow for the ability to add an ADU without some onerous restrictions. Like for instance, here in Spokane County, if you want to add an ADU, you have to be a resident either in the primary house or the ADU, and it has to be a family member. It can't be more than 880 square feet. So it's really restrictive, and it's specifically meant just in the event of taking care of a parent or a child, things like that. But if they were to adopt a little bit more flexibility in adding inventory units to single family homes, it would be one of the fastest and easiest ways to solve our inventory challenges.
And so, if I may,
Yes.
is there, I got to believe there's a market for that too,
Mhm.
because not everybody wants the, third acre
Yeah.
with a huge lawn and a
Right.
ton of landscaping.
It's highly political. It's a not in my backyard issue, because what happens is so say you have a beautiful house in a subdivision, and all of a sudden the zoning changes and your neighbor can now turn his single family home into a fourplex.
Sure.
How do you feel about that? Well, if that's your neighbor, you're probably not too excited about it. But if it's going to contribute to the greater housing good,
Mhm.
right? What's your stance on it? And
Sure.
what happens is in a lot of municipalities, you get pushback initially as people say that's going to lead to traffic congestion, poor planning, neighborhood blight,
Yeah.
you name
Sure.
it. There's
Sure.
always objections when it's happening in your backyard.
Right.
And so unfortunately, we just haven't seen really that forward thinking and opening up that planning process. So that is a fantastic question. And I think there needs to be more done to really modify that zoning and be more flexible, which could offer some quick solutions.
And Mike McBride had asked another question earlier, and it's you may have just answered some of this, but do you see Spokane ever getting serious about dense urban development in terms of real estate? Condos seem like a strong way to add more affordable housing. Of course, there's a legislative piece of that as well.
There's a legislative piece of that, another political hot potato. I'm so happy to address that. So back after the GFC, one of the bubble signs that we saw, of course, was in 05, 06, 07, every apartment complex turned into condos, right? That was a quick way to add inventory into the marketplace. Well, there was some legislation that was passed that basically allows open-ended litigation and liability for every condo association for 10 years up until 10 years post-construction. That was passed right after all those condo conversions, which makes it very, very difficult to build and construct condos here in Washington State, which is one of the reasons we haven't seen a lot of condo complexes here. Kootenai County has very successfully did the one lakeside building. They're adding more inventory. So the potentially overburdensome regulation has led to too much liability and too much cost for developers to put condo units on the marketplace, which is why they're going with Class A apartments instead.
Sure.
So, but I would say that's a fantastic way to add inventory, as long as the protections are in place, that the quality is not substandard, and some of the messes that, of course, people got into the craziness of the last market cycle.
And from our friend Brian Newberry. Hi, Brian. What advice do you have for parents for their college age or high school age kids facing these unprecedented prices?
Hi, Brian. Thanks for your question. I would say that's a very challenging issue. The bank of mom and dad is real and active right now. It would not be without the help and the assistance of many to contribute the down payment or offer a complete loan to get them into the marketplace. So that, unfortunately, really leaves out some people getting their foot into the door if they don't have that contribution from mom and dad. So that alone has really helped bridge that affordability gap. Because again, when we talk about some of these numbers that we were talking about, someone who's just fresh out of college, some student loan debt, they might not be in a strong financial position for many years post-education to get their foot in the door. So, and unfortunately, fortunately, I was one of those who bought right after college in the subprime market with like no money down. And so I know this generation has no sympathy for the fact that, that's how I got my foot in the door, was a very different market climate, very different lending standards. And when we talk about the differences between the corollaries of this market versus the last, the good news about this market is when you look at the mortgage housing indicator, your ability to get a loan in 2004 and 5 and 6 was dramatically different than it is today. You have to have an income, you have to have you have to have credit, you have to have a down payment. Now there's other programs like the Washington State Bond Program or the VA that will get you in with the down payment program, but it still is very different than what it was, where you really didn't have to have the skin in the game or the cash to get into an asset. So.
And one last question from Scott Obel. Good to hear from you, Scott. Do you see gas prices impacting demand for some of the developments in outlying areas?
That is interesting, because I would say yes. When gas prices originally peaked in 2008, there was an article in the Atlantic magazine that talked about how the dense urban areas were going to be the area that you want to be in. Fast forward to 2020, where did everybody want to be? Anywhere but here. So people wanted gardens, they wanted acreage, they wanted a strong internet connection, and just kind of, solitude and peace of quiet and peace of mind. So now that buyer is turning a little bit more to a more happy medium. And I think gas prices are going to affect everything. We know that the cost of fuel and inflation on household goods are affecting the average household by $6,200 a year, that is basically taken out of their pockets that they can't spend elsewhere. So if you're thinking and evaluating alternatives, the more rural properties that were so popular during the COVID period may not be so much, as we start to see that energy spike that doesn't seem to have an end in sight. So.
Well, thank you, Melissa.
Absolutely.
Appreciate it. Great to see you. Great to talk to you as always.
Thank you as well. This was a pleasure and a treat, and I appreciate all the questions and the opportunity.
Yeah, they were good ones. So please join us next month. We'll have Keonta Duncan with us talking about diversity, equity, and inclusion. It should be a great conversation, as always, with Keonta. Until then, enjoy the weather while it's good, and we'll see you soon.